If you have money sitting in the GIC, a guaranteed investment certificate, earning 5%, you might think you're being smart and safe. But here's what most people don't realize. You could actually be losing money even while your account balance grows. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Let me start by saying this. I'm not here to bash GICs. They absolutely have a place in your financial plan, especially for emergency funds or money you'll need in the next year or two. But here's what the data shows. With higher interest rates over the past few years, GICs have surged in popularity among Canadians. The problem? Many Canadians are packing tens of thousands, sometimes hundreds of thousands of dollars in GICs for 5, 10, even 15 years, thinking they're being responsible and safe. And I get it. The appeal is real. Your principal is guaranteed. That's literally what the G stands for. You know exactly what you get back. You don't have to watch the market's ups and downs. That 5% rate sounds pretty good. It feels safe. And emotionally, that safety feels like the smart move. But here's what we need to talk about: the hidden cost you're paying for that safety. And it's not small. Let's talk about inflation, not in abstract prices go up way, but in real dollars that affect your actual life. In 2024, inflation in Canada was running around 2.5 to 3%. That might sound small, but here's what it means. If you have $50,000 in the GIC earning 5%, after 1 year, you have $52,500. That's a $2,500 gain. But here's the catch: the purchasing power of that original $50,000 has dropped by about $1,250 to $1,500 because of inflation. So your real gain, the amount you can actually buy more with, is only about $1,000 to $1,250. That's a real return of 2 to 2.5%, not 5%. Now, let's say you're in a 30% marginal tax bracket. That $2,500 in interest gets taxed. You pay about $750 in taxes on that interest. So after tax, you've gained $1,750. After inflation, your real purchasing power increase is only about $250 to $500. That's a real after-tax return of 0.5% to 1%. Let me put that another way. On $50,000, you've essentially gained the purchasing power of about $500 after a full year. That's less than $2 a day in increased buying power. And that's in a good year for GIC rates. When rates are sitting at 1.5% to 2% for the most 2010s, people were actively losing purchasing power every single year. Now let's look at what this means over 10 years, because this is the kind of timeline where inflation's impact really becomes visible. Let's say you have $100,000 that you want to grow for retirement. You put it in a series of GICs, averaging 4.5% over the next decade. After 10 years, your account shows $155,000. That looks great, right? But if inflation averages 2.5% over those 10 years, which is reasonable based on the Bank of Canada targets, the purchasing power of that original $100,000 is now only about $78,000 in today's dollars. So in real terms, you've grown your money from $100,000 to about $121,000 in purchasing power. That's a real gain of $21,000. Now, factor in taxes. If you're paying 30% on that interest income each year, your after-tax inflation adjusted wealth has grown to maybe $115,000 in today's purchasing power. You've gained about 1.5% per year in real after-tax terms. Compare that to a balanced portfolio of 60% stocks and 40% bonds. Historically in Canada, that's returned about 6% to 7% annually over the long term. Even after adjusting for inflation and taxes, you're looking at real returns of 3 to 4% per year. Over 10 years, That same $100,000 could grow to $135,000 to $150,000 in real after-tax purchasing power. That's a difference of $20,000 to $35,000. Before I go further, let me be clear about when GICs absolutely make sense. One, emergency funds. If you need access to this money in the next 6 to 18 months, a GIC or high interest savings account is the right place. You don't want market risk with money you actually need soon. Two, short-term goals. Saving for a down payment in 2 years, that's GIC territory. You're not trying to grow wealth, you're preserving capital. Three, you already retired and you're drawing income. If you're already in retirement and you need stable, predictable income, having a portion of your portfolio in GICs makes perfect sense. You're not in accumulation mode anymore. Four, you genuinely cannot handle market volatility. If seeing your account balance drop by 10% or 15% would cause you to panic and sell, then GICs might be the right choice for at least part of your money. Emotional decisions cost more than inflation does. But here's the thing. If you have 15 to 25 years before you need this money, backing it all in GICs isn't being safe. It's costing you growth. So what should you do? First, let's talk about asset allocation. If you're 10 or more years away from needing this money, having some of your portfolio in stocks makes sense. A common starting point is to think about your time horizon. The longer your timeline, the more growth focused you can be. Someone 15 years out might consider a 60-40 or 70-30 split between stocks and bonds. Someone with 20 plus years might look at 70-30 or 80-20. This doesn't mean putting all your money in individual stocks or trying to time the market. It means using low-cost index funds like an all-in-one asset allocation ETF. In Canada, you have several excellent options from different providers. For 80% stocks, 20% bonds, XGRO or VGRO or ZGRO. For 60% stocks, 40% bonds, XBAL or VBAL or ZBAL or TBAL. For 40% stocks, 60% bonds, XCNS or VCNS or ZCON. For 100% stocks, all equity, XEQT or VEQT or ZEQT or TEQT or HEQT. These funds are from iShares, the X series, Vanguard, the V series, BMO, the Z series, TD, the T series, and Horizons, the H series. They're all diversified across thousands of companies. They actually rebalance, and the fees typically range from 0.15% to 0.24% per year. Yes, the value will fluctuate. Some years it will be down, but over 10, 15, 20 years, history shows that balanced portfolios have consistently outpaced inflation by a meaningful margin. Here's the key mindset shift. Safety isn't about avoiding risk. Safety is about protecting your purchasing power over time. And inflation erodes purchasing power, whether you feel it or not. If you're uncomfortable going fully into stocks and bonds, you can ladder your investments. 1 to 2 years of expenses in a high interest savings account, 3 to 5 years of expenses in GICs or short term bonds. Everything beyond 5 years in a diversified, growth focused portfolio. This gives you the stability for your near term needs while still letting the rest of your money actually grow. Here's the bottom line. GICs feel safe because you can see your balance going up. But when inflation is running at 2.5% to 3%, and you're earning 4% or 5%, and taxes take another chunk, you're barely keeping pace. That's not wealth building. That's wealth preservation at best, and wealth erosion at worst. If you're serious about building wealth for retirement and you have a 10 plus year time horizon, you need your money to grow faster than inflation and taxes combined. And for most people with that timeline, that means moving beyond GICs into a balanced investment portfolio. You don't have to take on huge risk, but you do have to take on some risk if you want your money to keep up with the cost of living and ideally get ahead of it. If this is making you rethink where your money is sitting, that's a good thing. It means you're thinking strategically, not emotionally. If you want to learn more about how to actually start investing in index funds in Canada, I've got a video on that. I'll link it in the description. And if you found this helpful, I'd really appreciate it if you hit subscribe. I put out new videos every week to help Canadians like you build real wealth and retire with confidence. Thank you for watching, and I'll see you in the next video.